Hi, it's Richard. Today's topic is how the use of technical indicators fits into the bigger picture of a trading plan. I think all too often we lose sight of the purpose of technical indicators, so it is important to discuss their use in the context of an overall trading plan. Trading is a journey of self-development. Along the way, there are so many self-improvement, trader performance, and trading methodology resources available that it is far too easy to get rather overwhelmed by the sheer volume of what's available and how each author takes a slightly different tack to the topic. The thing needed is a roadmap that distills this mountain of information down to something that is coherent and concise so that we have something in a form we can actually work with and which serves to keep pointing us in the right direction. So my goal today is to present such a roadmap that weaves together key concepts from many different sources. Consider making it a one-page summary in your trading plan that you can refer to frequently. Put it in your own words and add to it as you see fit. It is not perfect and by no means complete, but certainly feel free to share your thoughts in the comments below this video. To start, trading is a performance activity. It is a non-stop competition. All serious participants seek continuous improvement because, quite frankly, if you are not winning, then you are losing. There is no paycheck for just showing up or for doing shoddy work. The goal of trading is consistent profitability, or more specifically, the goal is to remain consistently profitable across each set of trades. Other goals, like financial freedom or working part-time, are secondary because they first require that you become and remain consistently profitable. How you define the size of a set of trades is arbitrary at first, and over time you will find what makes the most sense for you. The concept conveys that you have individual winning and losing trades, but that you are net profitable over some set of 10, 20, or 50 trades by an amount that you consider worthwhile to continue trading. This encourages you to think in probabilities and not be attached to the outcome of any one trade. Instead, you want to assess profitability using the outcome of each set of trades. As a performance activity, trading has three main requirements. I'm sure you have heard it said that it takes 10,000 hours of deliberate practice to develop expertise in something, whether it be a profession, trade, sport, or art. You need considerable passion and persistence sustain you to get those hours in. As humans, this presents a challenge because we are hardwired by nature to conserve energy in our minds and bodies. Most people quite simply aren't able to put in the time to do the work, even if they have some interest in that area. Alternatively, some decide this is not where their passion lies, so they choose to spend their finite energy and time in some other area of their life that they value more. This can be said for any performance activity. Part of that required work is that you must find and prove a trading edge. A trading edge is a method of trading that is sufficiently net profitable over a series of trades to make it worthwhile for you to continue trading. There are all sorts of trading edges, none are right or wrong. Start with one trading edge. Later you might have 2 or 3 edges, perhaps one for trending markets and another for sideways markets. Attempting to have any more than 2 or 3 edges is likely to backfire due to bogging you down in overanalysis, loss of focus, and conflicting thinking. You will likely have to experiment to find the edges that suit your personality. Next, you have to prove each edge is valid through backtesting or forward testing in simulation mode. Each trading edge you adopt has to meet the criteria you set for acceptable risk, reward, percentage winners, and frequency of occurrence. This testing phase yields a best case result. You will then need to track your actual performance under live trading conditions with real money, which should be lower than under simulated conditions. This takes us to the third requirement. You must develop the proper trader psychology or mindset to be able to consistently apply your trading edge. I am going to skip forward here and just say that trading literature emphasizes the need for your approach to be simple, focused, and consistent. I find it interesting that these three words are so interconnected in trading that I can't really define one without mentioning the other two. Conversely, lose one, and you likely have lost the other two. So there you have it. You need the grits to do the work to find and improve your trading edge, and then develop the proper mindset to trade your edge according to your rules over and over again. Remember, if you don't have a trading edge that you are trading consistently and for which you have stats on profitability, then you are acting at random and you have no idea what you are doing right or wrong. Such is not even fair to call gambling. Now let's dive in a little deeper on trading psychology and mindset. Two core ideas are common topics in the self-improvement and trading literature. The first is the idea that we each have two brains. We have a slow, analytical conscious brain and a fast, reactive, subconscious brain. The conscious brain is better suited to do complex tasks like calculus, but it is also that voice in your head, which unfortunately can raise doubts, conflicts, and other forms of negative self-talk. The subconscious brain can continue to drive your car long after your conscious brain has clicked off into a daydreaming state, or your subconscious brain can have you jump out of the way before your conscious brain can even register that you've crossed the path with a snake. We use the conscious brain when developing and evaluating our trading plan, but it is energy demanding and hard to sustain. The subconscious brain is less energy demanding and controls most of our activities. Autopilot, flow state, unconscious competence, or in the zone all refer to this state of high focus and concentration of the subconscious brain. The second core idea is that of habit. Performance excellence is the result of consistent focus on small improvements repeated over and over to form good habits. Complexity is attained through mastering many simpler tasks. Habituation engages the subconscious brain, making expert performances appear effortless. Habits that do not advance one's goals likely impede them, so removing bad habits is just as important as adopting good ones. Good habits let you go with your flow. The need for willpower, discipline, and requiring non-emotional trading imply an inner struggle against your natural tendencies and the need to instill better habits. So finally, we have arrived at two key takeaway messages. First, develop habits so your subconscious brain is executing your trading edge in a manner that is simple, focused, and consistent. And second, confidence is the outcome of knowing your trading edge is consistently profitable and that you are able to trade your edge consistently. Sounds simple, and it is, but it is definitely not easy. So let's flip this upside down and take a couple minutes to look at why most traders fail. The obvious answer is not fulfilling one or more of the three main requirements for passion and persistence, a proven trading edge, and developing a proper trading mindset. Again, if we drill down, we can identify any number of pitfalls that will knock us off our game. I will just mention a few here. First, trading in a simple and consistent manner can get boring, so we do the opposite, stirring things up to make things more exciting by taking impulsive trades rather than to wait for our next setup. In essence, we abandon our own recipe for success as a coping mechanism to avoid the short-term pain of boredom. Second, trading has a lot of misinformation and marketing hype. Marketing is geared to play to your ego, to sell you on the dream for the sole purpose of parting you from your money. Who wants to spend hundreds of hours at the gym when all you need to do is take some magic pill for $29.99 to get those six-pack abs? The downside is that once your ego is engaged, You start believing that it's the most expensive golf clubs or the fanciest shoes that make someone a top athlete. So as a trader, you start wanting more flash, more monitors, more charts, more indicators and features, more complexity, etc., even if these have zero bearing on your trading edge, if you still have one. A third pitfall is creative avoidance, which is making tasks more complicated as a way to avoid doing them. Many people simply do not like making decisions where it matters, so they avoid doing so every chance they get. All three of these pitfalls are examples of making trading more complicated than it needs to be. All are examples of self-sabotage. Arguably, all are examples of attempting to shift responsibility away from yourself. Let's look at it another way. Your state of mind and body determines your behavior and how you process information. Are you well rested, calm, and relaxed? Or are you experiencing boredom, anxiety, fatigue, anger, pain, or hunger? Change your behavior and how you process information, and it's like a different person is trading a different chart using a different method. Focus and consistency are reduced or lost. It is also worth mentioning that it is not enough to start the trading day in the right mindset. You need to be able to stay in it. Most of us get tired after a couple hours at the screens, so take a break to recharge your batteries. I chose these three pitfalls because we all experience times of boredom, ego, and avoidance, and I wanted to show how any of these can impact your mindset and your ability to remain simple, focused, and consistent. This brings us to our last topic. What can we do about it? How can we improve staying in the zone? First, set up your charts and indicators to support your simple, focused, consistent approach. If you don't need it, then don't show it. Only show information that directly supports and is required for you to trade your trading edge. This serves to minimize the number of monitors, instruments, timeframes, charts, and indicators you use to just what is required. Further, minimize distractions by not showing unused or redundant information or features. I consider my attention to be divided by the number of things I show on my screens. So if I show 10 things, then my attention is divided by 10. As an example, the market profile indicator has evolved into some mega indicator that tends to be highly redundant, showing the same information about 6 times. I do not consider the information shown to be particularly helpful to trading, so consider all these enhanced graphical capabilities to be more a detriment than benefit to trading. Most of those features should be turned off in my opinion. The next improvement you can implement is to let the computer do the mundane, time-consuming, and repetitive work so that you don't have to do it manually. Select indicators designed to help. Let the computer automatically track the key price areas where most traders look for trade opportunities. Indicators keep it simple and consistent, accurate too. Every time you stop to draw on your chart, you switch to your slow brain, divert your focus away from trading, add to your fatigue, and risk error either by drawing in the wrong spot or forgetting to draw all the things that you typically would draw. If you are using and drawing on multiple charts, you now risk not looking at the right chart at the right time when a trade triggers. Once you're done drawing, you now need to flip your brain back to trading mode. This definitely puts a strain on one's approach for wanting to keep it simple, focused, and consistent. Needless to say, being thoughtful to use the indicators that are right for you can help reduce a variety of unforced errors. So eliminate that unnecessary manual work and seek to minimize the unforced errors that you make. Here is my summary roadmap. The goal is to become and remain consistently profitable over each set of trades. Traders require passion and persistence, a proven trading edge, and the proper trading mindset. The trading approach needs to be simple, focused, and consistent. Efforts must be focused on the progression wherein many small improvements lead to consistency, development of good habits, an engaged subconscious brain that sustains the proper mindset while trading to ultimately execute the trading edge according to its rules. Within this overall plan, technical indicators are there to highlight areas where you look for trade opportunities, minimize distractions, and reduce unforced errors. In closing, I thought this quote by Bruce Lee was particularly relevant. I hope you have found this video helpful. Please remember to like this video, subscribe to our channel, and drop us a comment below to share your thoughts. Contact us by email if you are interested in taking a free trial of any of our indicators.